Australian Eagle Asset Management is an Australian boutique wholesale fund manager specialising in Australian equities. The company began managing money in February 2005 and since then has been one of the best performing investment managers in the sector. The Australian Eagle Growth High Conviction Equity Trust has outperformed its benchmark by over 4% per annum since inception, which is an amazing result for a track record of over 15 years. Looking deeper into the AFM profile of the fund, we can see that it has produced very consistent outperformance for its investors. As you can see from the chart on screen, the fund has produced very consistent outcomes, particularly during positive markets. But even during negative months, the fund has performed well, showing strong risk management. The chart on screen at the moment shows the drawdowns versus the index since inception, and it's very evident that while the fund has still had negative periods, they have been consistently less than the market. Importantly, the fund has performed very strongly coming out of these negative periods and added significant value to its investors. I'm joined today by Sean Sequeira, the Chief Investment Officer at Australian Eagle Asset Management. Sean, thanks for joining me.
Thank you very much for having me, Damen.
Sean, the fund has had very strong outperformance since March this year, as you did coming out of the GFC in 2009. How are you and the team viewing the market at the moment, and what do you think is in store for investors in the next couple of months of this year?
Well, thank you very much for the comments on the performance. It is actually part of our process that we do try and build portfolios that have a very, very good quality aspect to them. And that is part of the reason, probably the only reason really, why we have good performance in downturns, and particularly the two downturns that you have mentioned. How that relates to how we see the market going forward is that it will be very difficult going forward to actually predict what is going to happen. And the reason is that you have two very strong opposing forces. One is you've got markets that have moved almost in opposite direction to where most investment professionals thought it would be, and mainly the market has very quickly looked through the downturn. And try to work out what the investment earnings or what the company earnings would look like post this period, and really taken very little acknowledgement, I suppose, in some regards, in some respects, very little acknowledgement to the severe downturn in earnings that we're currently experiencing. The other force that's opposing that is the absolute phenomenal amount of liquidity that central banks have put into the market. It's quite well known. I'm not the only person to have noticed this. You can see it with the very large cash balances around the world in terms of money market funds, etc. And that liquidity is looking for a home in assets that return better than what they're receiving in risk-free rates, or even bank interest rates, which is almost negligible. So that return they're finding is better served in the market. So those two opposing forces will result, we think, in a very difficult market, a market that will be somewhat volatile in the coming year. And the last reporting season, we've just come out of a reporting season, we have noticed that there are not that many companies offering earnings guidance, and that in itself creates further volatility. There'll be vast, very wide ranges of expectations, and that creates certain volatility in the markets as well, and I suppose certain opportunities as well.
Speaking of opportunities, then, if you look forward to and potentially look in the past for potential investors in a fund like yours, what sort of markets do you feel that you optimally outperform in? And then, I suppose conversely to that, what are the sorts of markets that investors should expect your fund to underperform?
Looking through history, now we've been going for 15 plus years. It means that we've actually managed through significant downturns in the market, in the economy, a lot of volatility, as well as a couple of different operating environments that resulted from those downturns. We have shown that we can outperform in strongly rising markets. We can outperform very strongly and we tend to outperform to a greater extent in markets that are in correction or in a negative phase, such as you mentioned earlier through the GFC and the most recent pandemic. The times when we feel that we probably don't perform as well is when the market is looking very, very near term. It means that when the market has only a view towards the next 6 months, for example, 6 months of earnings, is when we tend to have performance that is not necessarily negative. We haven't had very strongly negative relative performance through our history. Maybe we've given back a little bit of strong outperformance, but then been relatively flat to market for a period of time. And that was a period of time when the market wasn't prepared to view the positive things that we would be looking at. When we tend to invest, if I may, I'll just give you a quick overview and why that might be the case. It would be when we look at a company, we'll look at 3 key factors. The first 2 are not controversial. We'll look at quality businesses and the valuation of that quality business as it stands. It's not, that part is not rocket science. You hear almost everyone say that in the market. I can't imagine you'll find anyone that says, look, we buy crap and we pay way too much for it. So it's not an unusual thing to say, look, we want to buy a quality business and make sure that we're not paying over a fair price for that. And from our perspective, a quality business will have five key attributes, and it is from the business perspective, from a businessman's type of perspective. We want it to be in a growing market. We want it to have a competitive advantage, have management that can take advantage of those 2 key aspects, have a balance sheet that can support their strategy without taking on too much risk, as well as the final thing is may make us somewhat different, is that we want the management to show that they keep the minority shareholder in their focus when allocating capital. So these are the 5 key attributes that we will score on a quality basis. We'll do quite a normal valuation process. I won't go into that. But the key difference which sits on top of this is that what we look for is in a quality company that is in a growing market, we want to find something that's changing within that business. And if that change results in a significant change in the earnings growth profile in the next 3 to 5 years, then that's a company that we would like to have good exposure to. And what we try and do is that we manage the risk of that change by incrementally increasing our position in the portfolio based upon the evidence that we see that change is taking place. So if a change is taking place within a company, we might put 1% of the portfolio in the company. If we're wrong, we don't lose too much. But if we're right and we get further evidence that that's occurring, we might increase our conviction, our quality of our assessment of the quality of the business may be improving. And as a result, we might get a relatively large position in the portfolio if we see continued upside from the changes that are taking place. And for us, a relatively large position in the portfolio will be 6%. So you can see over time, from if we see positive changes taking place, then the portfolio will get more. We will get more conviction in the position, and the portfolio will have a larger position. And as that change has taken place, we believe the quality is improving, and that means it leads to less risk within that business, and hence why we may have outperformed over a number of years through downturns would be a result of that high quality aspect from our perspective of the portfolio. Sorry.
Well, I was going to say, you've talked about a couple of different things there in the process of the fund. You've recently released a new fund, a long short fund. Has that been a natural progression from the way that you've managed your existing portfolio to move into starting a long short fund?
Oh, absolutely. Absolutely. What we found over the many years that we were running long only funds for institutions is that our research and our process naturally distinguishes those companies that we believe are of low quality and those companies that we believe are of higher quality. And in actual fact, we do actually have a lot of research that says that our distinctions between lowest and highest qualities actually have a marked return effect on those portfolios. There's those low quality stocks tend to underperform the market over long periods of time. And those companies that we believe are of high and improving quality tends to outperform the market. So what we would like to do is that we built a fund based around shorting lower quality stocks. That means companies that have poor positioning in their markets, have low or no growing markets, have poor management, or have, and more importantly, what tends to happen is that those companies that have much higher risk balance sheets or leveraged, quite leveraged, given their industry. Those companies tend to underperform, not only in general, but no matter their valuation, those companies tend to underperform in falling markets. Valuation hasn't been, a cheap valuation has not been a protector in when the economy is falling apart. Well, it's probably an overstatement, falling apart, but in the GFC, the economy was considered to be falling apart. Mm. And valuation was not a protector on a number of companies where they had poor quality. So there is a reason why they're cheap. And the first thing people do is they look through their portfolio. First, they sell out. They look through their portfolio and they said, if the economy turns down, what is at risk? What company cannot survive? And it's usually those poor quality companies. And they'll put further money into the higher quality companies that they believe will have a stronger position once they come out of the downturn. And we saw that in the GFC, and we saw that in the most recent downturn.
It's certainly a unique process, and it's taken 15 years and generated 15 years of very, very solid performance. So it appears to be working very well. Sean, thank you so much for your time today. Your fund is available on the AFM database, and there's plenty of information there about it. I thank you for your time, and have a great day.
No worries. Thank you very much. Thanks for the chat.